Hey, I'm McDonald, your real estate agent with Real Property Associates, and we're continuing our series, Questions That Every Homebuyer Should Ask. I'm here with your guest, Dan Keller. He's branch manager and loan officer with Guild Mortgage, one of the best lenders in the Seattle area. Another question for you, Dan. What is PMI, or private mortgage insurance, and then how can you avoid paying it?
Great question. So one of the more common questions for first-time homebuyers or buyers in general. So I'll start with this. If you do not put 20% down on a home purchase, you're going to be subject to having private mortgage insurance.
Yep.
Even if you refinance and you want to refinance and you do not have 20% equity, you'll be subject to paying private mortgage insurance. Private mortgage insurance simply is an insurance premium that you pay the lender every single month to offset your risk of default. That's really it. And then when you have equity with most loan programs, when you have greater than 20% equity, you then have an opportunity to get rid of that private mortgage insurance most of the time without having to refinance. So that in a nutshell is private mortgage insurance. Where I'll take it a step further is, depending on the type of loan program, Zach, will depend upon the type of private mortgage insurance you have. So for example, with FHA, with USDA home loans, and with VA home loans, you pay an upfront mortgage insurance premium upfront that's financed into the loan. So for example, let's say you buy a $400,000 house with the USDA home loan program, there's a 1% mortgage insurance or funding fee attached to that. So that's an extra $4,000 that's financed into that loan, okay? And then you have a small monthly premium. So different types of private mortgage insurance, but in a nutshell, those are the two types.
Yeah, and so is there a way to avoid paying it?
Yeah, the best way to avoid paying private mortgage insurance is to put 20% down. The other way, and the word avoid is probably not the best use because you're not avoiding it, you're just paying it a different way. But the other way to avoid paying monthly private mortgage insurance is doing what's called lender paid private mortgage insurance, where you raise the interest rate just slightly in lieu of having a monthly private mortgage insurance premium. Or you can just say, heck with it, I'm gonna buy it out up front. You talk to the lender and I will present 3 different options for you. You can pay for it up front, you can pay for it monthly, or you can pay for it in a higher interest rate. But those are typically the 3 ways to approach paying private mortgage insurance.
Okay, and for most people, is it cheaper to pay it up front or to pay it over time?
Really great question. So what I do is I'll evaluate that based off of the client. Every client has different goals. So what are your short-term and your long-term goals for this house? Most of the time, in a standard appreciating market, not one that we've seen over the last few years, but a normalized market, you're going to pay monthly private mortgage insurance for about 3 to 5 years. So depending on your tax strategy, depending on your strategy with the home, maybe opting for a higher interest rate to offset that might be best for you. But every client, every customer, it just depends.
Yeah, and then another follow-up question, is there like a standard amount of time, like maybe a minimum time that if you have your mortgage insurance, you'll have to pay it? So let's just say I decided I'm gonna put another 10% down on my house. Do I have to still keep paying mortgage insurance, or does it just automatically go off? When does that time?
Great question. Most of the time it doesn't automatically go off because that's how lenders make money. So you need to be working with a mortgage professional that manages your mortgage and helps you with that. So let's say you get an inheritance and $100,000 shows up and you want to put it down towards your mortgage. You would call me up and say, Dan, I want to recast my loan. And what a recast is it's different than a refinance. A refinance, you're subject to a new term, a new rate based on market conditions. We could recast your loan, you could put that $100,000 down. Now you owe less than 80% loan to value, and therefore we could petition to have your private mortgage insurance removed.
Thanks again for tuning in, and thanks again for coming on and giving us some of your time. If you guys like Dan and you want to subscribe to his channel, we'll link it up down below. You can also find him by searching Dan Keller in YouTube. And again, of course, if you like these videos and you want to see more like this, please consider subscribing to my channel as well. Thanks for watching.